Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, January 24th, 2023. It's 1:49 p.m. Eastern Time as I'm starting the video, and what I'm going to do is go over the equity markets, quick update there, take a look at the daily and weekly charts, maybe rifle through some of the sectors in the S&P 500 quickly, show you where they're at, and then I'd like to get to do updates on some of the energy uh, commodities, particularly oil and natural gas. All right, I'm going to start out here. Again, this is kind of redundant, but I've been talking about it a lot lately, and it's certainly, in my opinion, worth noting. The S&P 500 testing the primary, very clear as a day, as good as trend line gets, bear market downtrend line that comes in at the all-time highs. As I've commented on, typically when you hit it during a bear market, that's it. You get a big leg down, very profitable leg to trade. This is a bit atypical, but as I like to say, resistance is resistance until it's taken out. And what I mean by that is, you had that last tag, you got rejected, and the buyers have stepped in, and it's been a pretty voracious bid. Even the relatively minor pullbacks are getting bought up. So I'm going to say it like this. This is, it increases the odds, in my opinion, that the markets may want to punch through there. And until unless do, it's very easy, because if you want to take this as wishy-washy analysis, well, Randy, you're saying the markets could break out and run, but you're saying they can get rejected here. Yeah, but it's simple. Right now, I'll be very clear. What my opinion is not wishy-washy, is that the RR, the risk reward, is very unfavorable to taking new longs at this point in time. That doesn't mean we can't break out and run, and the RR favors being short here. It's wash, rinse, repeat. Let's not overthink it. Resistance is resistance until unless taken out. You have the downtrend lines and those 200-day moving averages right there, all coming in close proximity. As I mentioned, the NASDAQ 100. These are the charts I got out to you today. I have two trend lines coming off the highs there, and the second of the higher is BOD, or benefit of the doubt, trend line 2, and that's just like I said yesterday. We're right where we were yesterday, still about 2% shy, and you can see just underneath our perfect compression of the 200-day moving averages coming in together. Sometimes they're farther apart when the market moves, because the red line, the exponential 200-day, will respond faster to price than the 200-day simple moving average, and as I always say, I keep them both on my screen, because some traders will key in on one and some will key in on the others. Therefore, I want to watch them both, and all the better when they come together. So that is a confluence, a triple resistance. Three of what are probably, well, the downtrend line unarguably, and then the 200 days. Again, you can see the history of what's happened when we hit them in the past, and you go back to the 2002 or 2000 to 2002 bear market. Check out the 2007 to 2009 bear market. These are things I've highlighted many times in the past. This is quite often where they define bear and bull trends. When you're above those, the trend is bullish. So we'll watch that. Based on the fact we're making so far, you can see here in QQQ, and although QQQ isn't considered the stock market, if anything, the S&P 500, or even better, the Wilshire 5000, which I'll cover here in a second, those are much better indicators of the overall stock market. They have more representation of various sectors versus the tech-heavy QQQ. But make no mistake about it, even in the S&P 500, tech is by far the biggest component. In those big tech stocks, they are the biggest component of the tech sector, and so really where they go, the market goes. And I'm talking about Apple, Amazon, Microsoft, Alphabet, and Tesla, and Meta's falling down there a little bit, but Tesla and Nvidia you want to watch as well now. Oh, and as I said this morning, very important. All right, so I tried my best in December to caution, or at least share my experience, that December is a difficult month for trading. So, we're going into November. I was batting darn near 1,000, on trades, and then December was tough. I told you, if it wasn't for the site, I would have just taken probably the whole month off and stopped there. But I'll continue. My job is to give you analysis, and so if you did good in December, congratulations. If you did great, then congratulations there as well. But December was whippy as expected, and where I'm going with this is, so if you heeded that warning and maybe cut back or didn't trade in December, great. I don't think you missed much. And now keep in mind that we have, after the bell tonight, Microsoft reporting, then Tesla tomorrow after the market close, and then next Thursday, Amazon, Apple, and Alphabet. That is huge. And so where I'm going is the market, it could certainly break out or certainly get rejected. But anything that happens between now and really Friday, next Friday, because remember, Apple, Amazon, all these big techs, they tend to report after the market closes. Banks usually report in the morning before the open, and tech tends to report after the market closes, usually. So therefore, we're probably going to see some back and forth, aimless grinds, including and not limited to some whipsaws, meaning breakouts above certain levels, only to see that breakout fail. So do what you want. I'll continue to give updates and trade ideas and analysis like I usually do, but just keep that in mind. And then going back to what I was saying is, remember, it was tech that took this market down. Make no mistake about it. You have quite a few of the components, a lot actually, in sectors of the S&P 500, not far off or right off all-time high. They're bull market highs. They're all-time highs. Yet it was tech and the weighting that the big fangs had, and Amazon and the likes of that, and Meta being down over 50%. That's what took the market down. I've said it before. I've been saying it for years. Live by tech, die by tech. And so therefore, where I'm going with this is it's all about tech right now. We want to know where the market's going to go. This bear market's not going to be over until the bear market and Apple, Amazon, and Alphabet and all that is over. And, really, we're so far off the highs. So let's not get tied up in semantics here and talk about bull bear. Again, I only care about labels are great, and they like to use them on TV. I just care about the next tradable direction as a swing trader. If I go into active trading mode, I try to specify that's an active trade I might be in one day in and out, or maybe a few days. But the next tradable trend, let's just say the next 10 to 20%, will quite likely be determined by this battleground. If the bulls can take it out, remember, SPY's already there, but QQQ is quickly playing a game of catch-up. I highlighted that recently. I was very pretty adamant that on the recent lows that tech looked best, and that I've positioned long in favor of a rally, and that I was overweighted and really just focused on the tech stocks as a whole because they had the most constructive charts. It's simple. And a lot were at support. Now, with that being said, there's still potentially some more to go. And again, or we could get rejected here. Here's the thing, guys. It's just, you don't have to take a side right now and just wait and react. If you are bullish and you think that there's more upside or the bear market's over, you could certainly just wait for a breakout. And if you get a breakout above the trend line, the benefit of the doubt trend line, the 200 days, you can take that breakout. You can do a hard buy. You can start to scale in. You can then buy pullbacks along the way. And all you have to do is recognize that if it proves to be a false breakout, a whipsaw, and you go well back down below those levels, get rejected, then you just stop out. So it's simple. But trading 101 and investing 101 says you don't buy a rally into resistance, especially like I showed you this morning, an overbought rally. Any charting platform, the default when you put an RSI, which is a great indicator of how oversold or overbought something is. You can also look for divergences on that indicator. The default overbought reading is 70, but 70, good luck shorting QQQ on a rally into 70. It doesn't matter. That's not where QQQ really, it starts to get oversold, and sometimes you stop there, but I always look at every security differently. And on QQQ for at least better part of this year and last year, I've had a line right there about 80, and that's the extreme. That's about as far as it gets. And again, I gave you that chart this morning. So when you get to 80, sometimes you get a little more upside. If so, it's usually by putting in divergence, making a lower high. But the upside's typically limited, and sometimes it's a one and done. You touch 80, one and done, one and done, and one and done. Like you can see there. And that's what we just hit on there. So again, that doesn't guarantee the market cannot go up anymore. It just guarantees you that we're pretty overbought, and it's spent a lot of energy or fuel to get up to where it is right now, and that it's probably going to be tough sledding. And again, there's always gamblers out there, and the stock market's built on, large portion. There are investors and there's gamblers and speculators, and you want to gamble and roll the dice because you're betting Tesla's going to blow the cover off the ball tomorrow, or Amazon, Apple, and Alphabet collectively are going to. And even if they don't, again, I always say this: when earnings come out, don't react or put too much into what the numbers are. The important thing is the market's reaction, because I've seen many times where good earnings are already fully priced into a stock, and then it sells off on that good earnings report, or the other way around. At this point in time, remember, Amazon, a lot of these guys are really beat down. Amazon's still coming fresh off long-term support, pretty constructive chart, and that's right there, that level. 83.35. Last time, I picked it as one of my top picks was right here. On every occasion that it pulled back to that 103.31, that was one of my targets on the way down. And so we gamed first that pop there, and then we gamed that pop there. And now we gamed this pop there, or at least I did. Put out as a trade idea on the site, and that's that trend line you see on the daily. And so this is a big wedge, and Amazon could go on, end up breaking out of it. But again, how far is it going to run until earnings next week? Sometimes you can see if some of the early reports set the tone in the tech sector and people want to start getting in anticipation, even before Amazon reports. But the safe bet is to let the dust settle, especially if you're a trend or a swing trader, because I did say before, and I'll maintain it, that's another potential target and would still very much keep us in a bear market. That is the primary downtrend line, at least I have. This is a smaller secondary downtrend line. So whether Amazon breaks out or pulls back, forms this wedge a little better, maybe another run at 83.85. Remember, it hit check that 103 level for months there, a couple months, multiple pullbacks, and when the bears weren't able to take it down, the bulls got emboldened, and you got that rally right there, and you got that first one as well. So where I'm going is that would be, and it looks a little flaggy here on the weekly too. Look at that, impulsive leg up, little flagging type action, and that would potentially take us for a run up, and that would be a nice target, very much a potential target, the 200 days / 40-week moving averages, and or that downtrend line, and that would be from the lows there a 50% rally, and so technically speaking, you can use the term bull market, but it would also be bigger picture, and you turn off all the lines, or look at it this way, I'll leave the lines on. It would just be a bear market rally within a larger bear market rally with another leg down to come most likely. So again, these are just potential targets. I'll let you know my thoughts on them after this week. Right now, I'm kind of almost coin toss. Like I said, we're at those levels. You can't deny on QQQ SPY. Let me show you the Wilshire as well, because that's a very important index. Let's look at a weekly chart. Let's even start out on monthly, see if I have any lines on the monthly. There it is. This is the Wilshire 5000. History on this program only goes back to 09, but it captures the entire bull market since 09, and we're at that pullback to the bull market uptrend line. So, and I'm going to go through the Qs and SPY on this time frame as well for you. But so glass half full, meaning if you're a bull, well, you just pulled back a couple months ago to the primary bull market uptrend line. You had an intra-month violation there, but you quickly recovered it. Actually, you barely closed a month below it when COVID hit, and the following month you closed right back on it. And then, so that is, so far you can make a case, buy pullbacks. Here's what happened. If you bought every pullback to that trend line, you got golden entries, and maybe that one will prove to be that. On the flip side, you have one of my favorite indicators, a 20-month exponential moving average. That blue dash line does a phenomenal job of defining bull and bear trends, and that one says, hey, we took it out. Actually, we took it out that month back there, early 2020, right there. Solid close below it, and at the end of April, and every single month, without fail, except this 1 month here, we didn't test. Every single month, it tried to make a run at the 200 or the 40-week, 20-month moving average, and failed to get through it. So what starts to change the picture? Well, a solid green candle that prints the end of the month back above that level. Let's look at it on the S&P 500. COVID kind of, this is what I call my nickname for the COVID bear market. 36% drop in the S&P was Ursa Interruptus. There was already a bear market priced into the economy, come with pandemic or no pandemic, the charts, the technicals, everything. But the Fed overreacted, and not just the Fed, in Washington as well, with excessive stimulus, both monetary and fiscal, and so that just gave a little extra life, just like a patient dying on the OR, and you just pump him so full of adrenaline that his heart's going to keep beating even if he's brain's not functioning, and technically you don't die till your heart stops. So something kind of like that. Let's just say they hit the patient with too much adrenaline there, and that took us up. But either way, you can see we still have a nice clean trend line there, fairly clean. We're also below, just like the Wilshire, below the 20-month, which again has done turn off all the lines, and you can see how well. The only time you spend below there in bear markets. That was the last real bear market, in my opinion, 2007 to 2009. You took it out there in early or late '07, and you remained below it. And then it told you here, hey, bear market's over. It's a bull market. Now you want to buy pullbacks to that level. And so that's it. Oh, and then the NASDAQ, QQQ, well below, it's like everything else, below that, and it's just done a bang-up job of defining bull and bear trends. And so by that indicator, it's not the be-all, end-all, it's a good one, we're still below. So like I said, glass half full, empty, glass half full. And then the NASDAQ 100 trend line, my primary trend line off the '09 lows on the monthly comes in right here. And that we took out, but we've been back testing it from below. And we're also down below the primary bear market downtrend line. So by just about every metric, or at least 3 metrics on this chart, the primary uptrend line, which we're below, the primary bear market downtrend line, which we're below, and the 20-month moving average, we're in a bear market. So let's not overthink it, folks. Maybe the bear market ends, or at least we get a good rally if all these levels get taken out, and then I might change my tune. So I'll maintain what I've been saying, that this is an objective area to be closing out long, especially in front of earnings. If you caught most of that big rally we've had in the last few weeks, and or putting on some shorts, if you're a trend or more patient swing trader, because you're going to have to ride out some volatility through earnings week. You want to play it safe, you can wait till earnings are over. My preference, I like to get in front of that because you're in a bear market. If you wait till the last of the Apple, Amazon, and Alphabet have reported, which will be really Friday before the market opens, because they report after the close on Thursday. My guess is you're either going to be way down here sharply, or you're going to pop that and run sharply to the upside. That's my best guess. I don't think you're going to open the day on Friday and remain anywhere on this level. I think the market's going to pick its direction no later than next Friday of next week. Of course, that's the last trading day of the week, but I think that'll start to give us some clues. Okay, let's just run through big picture stuff. We're on the monthly time frame again. That's every single candle is one whole month of trading. You can go back years. You can go back as far as you want usually, or as far as security will go, or an index. This is XLK, the biggest sector in the S&P and NASDAQ 100. And so glass half empty. You took out the 20-month exponential moving average back here in the beginning of 2022, and you remained below it and got rejected on each and every attempt to get above it. You either fell reversed back off it, or closed the month below it, failed to close the month above it, and we're still under it, right? We're just spitting distance from taking it out, but that's, again, we've been every month except this, what was that, 1 month down here in October. That was the only month we did not test that level, trade on it. So we can go up, and then on the flip side, we have the primary bull market uptrend line. So this, if and when taken out, indicates or opens a door for a much larger drop, and will probably tell us we're in a what I suspect we're heading into a much, much, much different bear market than many folks imagine, because of recency bias. Like I said, this is, we haven't, the bear markets that for the last 50 years, since the one from the late 60s to mid 70s, every other one since then has been kind of over before you knew it. No, usually under 2 years, and average length, I don't know, 15 months, something like that. Some of them lasted, like COVID, just a matter of weeks, 6 weeks. So All right. All right. XLK, XLV, healthcare. See, a lot of these sectors haven't yet rolled over, at least by this metric. Healthcare has been holding up. It's above its primary bull market uptrend line that goes off the early '09 lows, and it's also above the 20-month moving average. And I did a video recently. I said, this is where, if you want to hedge up and do what the pros often do, especially hedge funds, in the last few weeks, the trade was, as I said, to be long tech and then short the select stocks, certain industrials, individual stocks or individual sectors, especially those that were trading recently at or near all-time highs. And those are the ones that are starting to roll over. They're significantly underperforming. To underperform the market, meaning tech, you either have to drop while it goes up, or you go up a lot less. And that's what's happened to just about every one of those short setups that I highlighted recently. All right, so there's XLV. Hasn't broken down yet, but we'll watch that one. XLF, that's already below the primary trend line right there. XLY, consumer discretionary. You see a lot of trend lines, but this is my lowermost, or BOD, benefit of the doubt, with 1, 2 when COVID hit, and then 3 reactions. And we're right on it right now. And so, glass half full folks, meaning bulls, can say, hey, I buy support, I buy pullbacks to trend lines, and that may work, but you're also below the 20-month moving average, which again does a great job. COVID, we were below it 1 month, but then the Fed refused to allow a bear market, and the government. And but in other points in time, you go back at most points in history, once it was taken out, like in '07 right there, you back tested, and see, in the beginning of the bear market, there's a lot of non-believers out there. And so there's always a point. We haven't seen that. In this bear market, I said I thought would be atypical and different from the rest, and it has been. But usually at some point you get that point of recognition where you get a powerful leg down, and that's we still haven't seen that. Whether it's coming soon or not, I don't know. Just thing about it is just be aware of that. If you're caught on the wrong side of the trade, and even if you're short and you're caught on the wrong side of the trade in a rally, don't underestimate how far and fast, especially to the downside. Stocks tend to go down much faster than they fall. So if you're on the wrong side of a trade in a bear market, you're going to get wiped out or feel a lot more pain a lot faster than you will if you're on the wrong side of a bull market, by being short for that reason. All right, XLI, industrials, yeah, kind of messy chart. XLP, look at that, consumer staples, hit the uptrend line, but still above it. And, so kind of a mixed bag. XLE above the primary uptrend line. These are the long-term charts. Remember, these are the monthly charts I'm going over. Utilities, look at that beautiful little uptrend line off the lows. And so that's where we're at right now. This is big picture stuff. We're at key support levels. And so, the market, pretty much the easiest way to say it, I think, is if the market takes out the recent lows by a good amount, and these uptrend lines in the Wilshire and S&P and everything, then you're going to have all those other sectors that just recently are either right at now or just recently hit and bounced off trendline support. And then, in my opinion, that's going to firm up the case that we are in, that this wasn't a typical 18-month or so bear market, that this is just the beginning of a much longer new secular bear market with a lot more downside to come, a market that's probably going to take equities lower in the coming years, not just the coming months. Again, that's my opinion, but we got to take out all those trend lines, and see those sectors that haven't fallen under the 20-month exponential moving average, or whatever their average is. Sometimes I'll tweak it, and some sectors respond a little better to one average or another, so you can play around with that. Okay, promised you energy. Let's move on to energy. Natural gas, that last trade did not pan out. We didn't hold the, let me get my box tool going here, color it up blue. This was a support zone. Started highlighting a buy at the top of the zone down to the bottom, and we just continued on down through there. Do we bounce? Oh, absolutely. We're going to most likely bounce soon. We're very oversold. And if you look at, this is a long-term chart. I'm on a weekly chart going back to 2008. And you can see this is sort of a range most of the time for the past couple decades here. natural gas is traded in this range, in that box. And there's been a few periods where it went crazy to the upside, and then a couple times where it just collapsed on the downside, right? COVID was one of them. Everything got sold during COVID, and there was a drop there. So we're kind of in no man's land. I don't have a strong opinion based on this chart. Let me show you a couple others. Okay, that was the weekly chart. We zoom in a little tighter here. This is a daily chart of natural gas, and I'm only going back in this one to August of 2021. But here, what I wanted to focus on are a couple things. You have a very steep and somewhat well-defined trend line. I've heard over the years a lot of folks say if the steeper a trend line is, the less valid. From my experience, natural gas, because the way this thing moves, quite often it's either full throttle up or full throttle down with really no middle speed there. There are times it'll consolidate, but therefore I've noticed that these steep trend lines often do spark sharp reversals. And if you have traded this one before, you know that it's going to go down, 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 and on one day, pop, it goes up. And what may cause that? Obviously, one of the things here I noted on this time frame, again, daily chart. Every security is different, but on some I look for low-level bearish PPO crossovers. What does that mean? The line I just drew here, that's a zero line. Every PPO or MACD, if you don't have the PPO, will give you a zero line. And so I look for bullish crossovers below, and I see 1, 2. There was a rejection. There's a great instance. It looked like you were going to get it, but the line's rejected. And then the cross came right here. 3. I circle here. We haven't yet crossed, but look how the lines are rolling over. We're very overbought. We're down at the 30 level on the RSI. Last time we were overbought is here. So let me just do that. Let me just draw these arrows up for you and show you. Oh, there's the crossover. We're just coming off oversold readings. I said overbought, I meant oversold. Very close, not all the way there. But the bullish PPO crossover did the trick. You got it right there, and that was the bottom. Didn't go up immediately. Took about a week, but it stayed at the same level, and then you got all of that. This time around, here was our crossover. You can see right there, we hit the 30 level on the RSI, so we're oversold right before that. And that's about right there, right after. Right here was our bullish crossover after the rejection where you did not get across, so that wasn't even a whipsaw. You had an extreme oversold reading right there, and right after, there it is, that arrow straight, and you got a rally. And believe me, these are big rallies. So it goes from 550 up to 750, $8, no, almost 850, 825. That's a substantial rally, and so that's it. So that's one of what I'll be looking for. Number 2 would be a break above there. Let's see what I have on the short-term charts. That last contract I took was the February, I think, but where the Februarys are going to stop trading this week, so I'll grab the March here for you in a second. I think I have them both up. Let me see. NG, I don't even know if I can cue in the Februarys. It's not the continuous anymore, so if I click on this one, my lines might not even be, my lines aren't there anymore, but you can see you still have divergence here. You've had divergence for a while. This thing can't just get going. But let me show you the March contract. Let me just change this one here. Let's do that. NG continuous now being the March, and there is the pretty much trend line right here. It's not a great perfect trend line, but again, you want to watch for that bullish crossover in the daily. There's our recent divergent low, and if you look at the trend line there, breakout back test. These indicators have been turning up. You go to, take it a little farther, go out to, let's say, a annual chart, yearly chart. There it is. There's the PPO right there, right? There was on the natural gas futures contract here. The other one I was showing you is the continuous from stock charts, but there, we've got it right now. Boom. Or, I'm sorry, we don't, but they're kissing. The lines are kissing. If we get the crossover, you can see last time was right there. I'm looking only at the low level crossovers, well below the zero line, and the previous was over there, and then one probably right around there somewhere. All right, so yep, that's that. And remember my whole theme about the resumption of, or the vicious cycle between commodity prices, or inflation, and the stock market. Light crude, which one do I want to show you? Crude, the chart isn't, I don't have anything screaming, some great levels to look at, but I can say this, this is one of the biggest components of the inflation trade. Crude oil prices, they have a bigger impact than nat gas prices, and this is the trend line I'm watching. We're still above trend. Prices are elevated. They're near, this goes back all the way to 2013 or so, and I think most others believe inflation's here to stay for a while. The situation in Ukraine and Russia, that's certainly not getting any better. It's getting worse, if anything else. We have 2 more years left in this administration that made oil a public enemy #1. So there's really no help there anytime soon coming. And so therefore, the backdrop, unless we have demand destruction with a big leg down in the market, consumer just really craters here and tucks in the shell, and that's a trend to watch. You can get demand destruction. Otherwise, again, it's a vicious cycle or negative feedback loop. Stock market rallies because of lower inflation, falling commodity and inflationary forces, and then because the market rallies, consumer sentiment's up, spending occurs, and then money will come back into commodities. Commodities start going up again, and then the cycle continues. So we'll watch that right now. So let's watch for that. Let's see if crude oil breaks this trend line right here. Let me give you USO. I'll show you that one. And just remember, USO or natural gas, crude oil or natural gas, they can rally for a week. They can rally for a few weeks. It's just the longer those rallies go on. This is a weekly chart here of USO, by the way. There's a trend line that goes all the way back to 2008, and that one was taken out. So this is bullish. And remember, I've maintained this adamantly that commodities ended a very long or pretty powerful, decade-plus bear market and the COVID lows. And by most metrics, those we're in a new bull market. And you can see here on USO, it took out the primary bear market downtrend line there, and we've been back testing it since. So, the most likely scenario is after back testing for a while, you can even draw a little wedge type thing here, and a break of that trend line should send us up and continue on. So there's USO, and if you look at it on a shorter term perspective, this is that same trend line I just gave you on CL or crude futures, WTIC. It's the same thing. Stock charts calls the continuous contract WTIC. It's West Texas Intermediate Crude. You got multiple reactions on this trend line, so that's the one to watch. And there's good support just below it, about 58.60, but we recently hit the trend line, and we did so with positive divergence, and we've been moving up, and there's that downtrend line. So this is this right here, and this, the divergence line and the primary uptrend line, and then this downtrend line. Those are the levels to watch. If crude can pop that, USO's headed up here to 71.40, and if it can take that out, it's going to make another run, I believe, at the previous all-time highs of 91 or 92 right there. And look, if it breaks this, and then it breaks that, and that's going to be good for the stock market, unless it's happening because the stock market's cratering, if that makes sense. In other words, if the stock market can hold up and the consumer can hold up and crude prices go down, well, it shows that, hey, the Fed did do it. They did engineer that soft landing. They were able to take care of inflation and not crash the economy. So great. However, if you're seeing crude dropping like this and the stock market's falling, that negative feedback loop may not kick in for a while, because you're going to get to one point, and I believe it, if you take out all those primary uptrend lines I gave you before, really take out much below the recent lows in the stock market, you're going to get to the point, which we haven't seen yet, that waterfall selling. You're going to see and hear about major concerns and possibly blow-ups of pension funds. We've seen a lot of institutions, especially mostly in the crypto arena, blow up. But that's one thing that this bear market's lacking. Everything's kind of, at least in the financial sector, holding up. And so my point being that if we get a major leg down in the bear market, crude could be falling. I wouldn't go buying stocks until the charts tell you it's time to buy stocks, because this would be, yeah, an abatement of inflationary forces, but it would also be due to tremendous demand destruction by people not taking vacations and driving around as much and flying airplanes as much and all that good stuff. All right, I'm going to wrap it up here with one more, and that's coffee. I was going to share this one last week, and I didn't get around to it, and I'm going to share it now. You had a downtrend line right here. And that's actually right when I noticed it, so I held off because I thought we had an uptrend line. I thought that uptrend line might break, and it did, and it was also nice support there, and we undercut it. But the fact that we briefly undercut it, we had a breakdown in the trend line. We had a pullback as expected, but then the buyer stepped right in. That's pretty bullish. I'm going to show you the daily chart of JO, the coffee ETN, in a second. So I'm liking coffee. Can't make a screaming case right now, but I think it can rally up here at least to that 175 and quite possibly more. Because remember, we are. Oh, maybe I'll be right or wrong, but so far, and I've left. Some of the trade ideas that are from back here are still long-term trade ideas. I pretty much was looking for a new bull run in commodities back here, and we've had that. Some have corrected more than others, but if you look at just this chart of JO, let me turn off all the lines here. JO is a coffee ETN. You can see that we've pulled back now to really see this basing pattern here. Remember, a lot of commodities were in bear markets. You had a multi-year basing pattern, and then boom, you broke out, you back tested, had a rally, and now you came back down, you back tested again. So this is where you buy coffee, even if you didn't nail the bottom. Sorry I didn't see that last week or the week before. When I did see it, I was expecting that pullback, but it's not too late in my opinion. I would maybe not a hard buy because you have some resistance here, but you can see not only did you back test that support level, but you also have the first nice, really big positive divergent low here on the daily chart in a while. And in a bull market, it's usually these divergent lows that send you to the new highs and beyond. And so the new highs are quite a ways up there. Coffee is volatile. It's not as volatile as natural gas. It's not as volatile as lumber, but close. It can move quite a bit. That'd be a 50% run in JO just to go back and retest those highs. So, again, maybe a scale in, not a hard buy now. You'd have stops below the recent lows or even tighter, because if that was a bottom, sometimes they might want to double test it, but usually that's it. So you can have a tight stop there, a more liberal stop there, but that's all also relative to what are you targeting. And if you're targeting those previous highs, you get back up there, I think it'll be very clear to most that we are in a commodities bull market, and you'll probably, maybe get a reaction, but you'll probably take that out and ultimately go into new highs there. So, what I keep telling folks, well, JO wasn't around then. You had the old JJOFF, that's what it was. They restructured this one, and this, now you trade JO. But this is the same one, same company. They just kind of revamped a lot of their ETNs. And the point I try to make here is that back at the end of the last bull market commodities, if you believe that we are in early stage bull market action, like I do, then ultimately, is it too much to think that we're going to at least visit the highs from the previous bull market over, it was over, in this case, about a decade ago, a little over a decade? I don't think that's much, especially considering we were in one of the lowest and most benign inflationary environments for decades back here. We are now in, there's been a little abatement recently, but in the way it started out, and we started out with much more of a bang than the hyperinflationary environment back in the 70s. So I think that might be conservative to say that we're going to go visit and stop at the previous bull market highs, especially if inflation is if we have sticky inflation that's here to stay. So anyway, so this is, these are trade ideas for you. And like I said, if you're going trend trading, investing, then you don't have to do hard buys. You can just, average in and scale out of positions. Scale out, when you have big runs, big rallies, you get negative divergences, overbought, at resistance. That's when you take profits and sidestep, and then you buy it back on divergent lows and pullbacks to support. Okie dokie. I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.